Welcome to the Deep Dive, your shortcut to being well-informed, packed with surprising facts and just enough humor to keep you hooked. Today we're plunging into a topic that, well, for many feels like it's out of your hands, but is actually one of the most pivotal moments for your financial future. A workplace pension change. We're specifically talking about a scenario like Microsoft employees moving from Fidelity to LifeSight. It's a real-world example of something that affects, so many of us.
And you've hit on a crucial point there. While a change like this might feel like a decision made for you, it's actually a golden opportunity. Think of it less as an inconvenience and more as a powerful prompt to hit refresh on your personal finances and ensure your retirement savings are truly on the path you want them to be. Our mission today is to peel back the layers and show you precisely what steps you need to take to make this transition work for you.
Okay, let's unpack this. Our first beacon in this financial journey is simply understanding the landscape. What exactly is a workplace pension? At its simplest, it's a savings pot where both you and your employer regularly contribute, a slice from each payslip. That money isn't just sitting there, it's invested with the aim of growing substantially over decades to build your retirement fund. Employers decide to switch providers for a whole host of reasons. Maybe they found a new provider offering lower fees, perhaps a wider range of investment options, better digital tools, or sometimes it's simply due to business growth or even new legislation.
And that leads us to the absolutely critical first step.
Yeah.
Diving into all the paperwork you receive. Look, I know, it sounds tedious, but this isn't junk mail. These documents are your direct line to understanding exactly what's changing, when it's happening, and most importantly, how it directly impacts your money. My advice: create a dedicated file, digital or physical, just for these documents. Don't let them gather dust because ignoring them means, well, ignoring your own financial future. If anything at all is unclear, pick up the phone to HR or the new pension provider. It's your money. Demand the clarity you deserve.
Couldn't agree more. And don't dismiss those company webinars or meetings your HR department might arrange. They can be gold mines. Often these sessions provide additional, sort of nuanced information that might not be explicitly detailed in the written materials. Plus, you get a live Q&A opportunity. You might hear someone else ask a question that uncovers something crucial you hadn't even considered.
Precisely. Yeah. Come prepared with questions like, what's the core reason for this provider change? Is it about fees, performance, or something else? How do the fees of the new provider, say LifeSight, compare directly to Fidelity? What happens to all the money in your old pension pot? Does it automatically transfer, or do you have choices? And critically, what's involved in choosing your own investment fund rather than just, accepting the default option?
Right. So once you've got a handle on the why and the what, your very next non-negotiable step should be setting up online logins for both your old Fidelity pension and your shiny new LifeSight pension. LifeSight even boasts a mobile app, which is a big plus for convenience. But whatever the platform, get this done immediately.
This is absolutely foundational for maintaining control. Why? Because immediate online access allows you to verify that both your contributions and your employer's contributions have been correctly added. You can check things. You can review your investment selections, access important documents, and, vitally, confirm your death benefit nominations. A topic we'll definitely circle back to later because it's so often overlooked. Having that portal access right away is your lifeline in the weeks following a transition. Beyond that initial period, getting into the healthy habit of logging in at least once a year is just smart financial hygiene. And a pro tip: use a secure password management system to keep track of all those login details. It saves so much hassle.
Okay, now let's talk about those contributions you're making. Sometimes a provider change might come hand in hand with adjustments to contribution rates.
Right.
This obviously has an immediate impact on your take-home pay, but the long-term ripple effect on your retirement goals, that's where the real power or peril lies.
It's true. Even small adjustments can create massive differences over time. Increasing your contributions beyond the bare minimum legal requirement can genuinely transform your retirement picture. Let's look at a compelling example from our sources. Imagine you're 40 years old, earning £40,000 with 25 years until you retire, and your pension investments are growing at, say, a steady 7% annual return. If you save the legal minimum 8% of your qualifying earnings, you could have around £217,279 in your pension pot, roughly. But if you just nudge that up to 10% of your earnings, your projected pot could jump to 271,599 pounds.
Wow.
That's a difference of over 54,000 pounds simply from an extra 2% contribution. So be honest with yourself. Is any excess money you have each month truly being put to its best use? Tools like Money Helper's budget planners or the savings and spending planners available through your LifeSight online account, they're fantastic for assessing if you can afford to contribute more and actually see the impact.
Okay, speaking of those contributions, it's not just how much you put in, but how it's collected that makes a monumental difference to your take-home pay and, crucially, your tax relief. This next part is where your money can truly work harder for you, and it's a concept that surprises many.
It absolutely can. At its core, pension tax relief is the government's way of saying thank you for saving for your future by essentially topping up your contributions with money that would have gone to tax. Simple enough, right? But how that top-up arrives is where it gets a bit tricky, with three main methods. First, there's relief at source. Here, your contributions are taken from your pay after tax. The pension provider then claims 20% tax relief from HMRC on your behalf, adding it to your pot. Now, if you're a higher or additional rate taxpayer, you need to proactively claim any additional relief you're owed via your self-assessment tax return. Many don't realize this last part.
Right, that's easily missed.
Definitely. Second is the net pay arrangement. This is simpler for some because contributions are deducted from your pre-tax salary. So you automatically benefit from tax relief at your marginal rate without needing to do anything extra. However, a crucial point here is that low earners who don't pay income tax might actually miss out on this relief altogether under this system.
Ah.
And third, increasingly common, is salary sacrifice. This sounds technical, but it's actually a brilliant hack sometimes. You agree to reduce your gross salary, and in return, your employer pays that exact amount into your pension. The magic. Because your salary is lower before tax, you pay less national insurance contributions, a direct saving for you. And sometimes your employer even shares their national insurance savings with you too, boosting your pension even more.
That sounds pretty good.
It can be. The downside is it's generally less flexible to change unless your personal circumstances significantly shift.
That 1.3 billion unclaimed tax relief figure you mentioned earlier, that's just astonishing. What's the biggest reason people don't claim it back? Is it just too complicated?
It's often simply a lack of awareness, honestly, or perhaps the perception that claiming it back is too complex. It feels like admin. But that 1.3 billion unclaimed between 2016-17 and 2020-21 isn't just a number. It's money sitting unclaimed, possibly in your pocket, waiting for you to simply ask for it. The real insight here is claiming your higher rate tax relief isn't just a bonus, it's a return on your financial literacy. It's a direct financial incentive for understanding how your pension works. And remember, you can only claim back for the last 4 tax years, so don't delay.
Good point.
To put it starkly, for a basic rate taxpayer, £100 added to their pension effectively costs them £80. But for a higher rate taxpayer, that same £100 only costs them £60 after tax relief. That's a significant difference that can dramatically accelerate your savings.
Wow, yeah, that really highlights the power of understanding these details. Okay, let's shift gears slightly to choosing your new investment options. We know LifeSight has a default investment fund, but it's a big concern for many listeners that this default might not align with their personal goals or, their comfort level with risk.
That's a very valid concern, and it leads to a core insight. Default doesn't mean optimal. While convenient, these funds are built for the average, not your unique retirement vision. LifeSight's default fund is what's known as a lifestyle fund. This type of fund automatically shifts your investments towards less risky assets as you get closer to your retirement date. It's designed to be cautious, basically. Our sources highlight 2 general types. One that targets an annuity purchase that's trading your pot for a guaranteed income, and another that targets a drawdown plan, where you keep it invested and take income. These funds also typically assume you'll take 25% of your pension as a tax-free cash lump sum, meaning they'll move a quarter of your assets into cash in anticipation of that.
Okay.
But what if that's not your plan? What if you're a late saver who needs to take on more risk to grow your pension adequately? Or, conversely, maybe you're younger and more cautious, you might find it too risky in its early stages. It's important to note how common this autopilot approach really is. Our sources say over 99% of investors in Nest and 98.61% in the People's Pension are in their default funds.
99%, that's staggering.
It really is. A huge number of people who aren't actively managing their money.
That's a huge percentage sticking with the default essentially on autopilot. So, For you listening, here are some key questions to ask yourself. What's your actual time scale to retirement? How comfortable are you with volatility, with your investments going up and down? Does the default fund truly meet its benchmarks? And, more importantly, does its aim match your personal objectives? And also, be aware that some funds may add additional costs. If you're unsure about any of this, don't hesitate to seek out an independent financial planner. It could be the best investment you make.
Absolutely. And while you're focused on your new pension, let's not forget your old one. This is the perfect time to take a good, hard look at your Fidelity pension investment too. Even though you won't be contributing to it anymore, it's still your money working for you, and it's a critical time to review its performance.
Exactly. It's still a significant part of your financial future, and it
Yeah,
needs to be pulling its weight, right?
right. You need to check if it's achieving its stated aims, how its performance holds up against its benchmarks, if you're comfortable with the volatility it has shown, and if its objectives still align with your current personal goals. Our sources provide a powerful example of why even small differences matter enormously over time.
Hmm.
If you have, say, £50,000 in your pension with 25 years to retirement, a 6% annual return would grow to £223,248. But at a 7% annual return, it grows to £286,271. That's a £63,023 difference from just 1% more in growth.
Wow, 63,000 pounds. That's huge.
It is. That pot will continue to grow, so it's vital. It's performing as well as it possibly can.
That's a powerful argument for reviewing those older pots. But what if your investments could do even more than just grow your pot? What if they could also reflect the values you hold dear? That brings us to a growing trend. Aligning your money with your values by considering sustainable investment options, or ESG investing.
Mhm. ESG stands for Environmental, Social, and Governance Factors. These are non-financial considerations that many investors now weigh alongside traditional financial returns. So we're talking about things like a company's climate impact, its labor practices, diversity on its board, and its overall corporate governance. The bigger picture stuff. Many pension providers, including LifeSight, now offer ESG-focused funds. These funds typically filter out companies that don't meet certain criteria, like those involved in fossil fuels, tobacco, or weapons, and instead favor companies with strong environmental policies or ethical supply chains.
Okay, so investing with a conscience, basically.
Right. Essentially, yes. While there can be potential downsides, such as sometimes lower diversification or maybe slightly higher fees, the upside is that your money can actively support businesses that align with your personal values. And the performance isn't necessarily sacrificed either. A 2020 study found that 86% of ESG funds delivered neutral or better performance than their conventional counterparts after all costs. Before selecting one, make sure to read the fund's fact sheet, check independent ESG ratings from providers like Morningstar or MSCI, and ensure it genuinely matches your values and risk appetite.
Right. Good advice. Now, thinking about all these different pots, your old Fidelity one, the new LifeSight one, maybe others, you've probably noticed that most people accrue multiple pension pots throughout their careers. It makes perfect sense when you consider the stats. The average UK worker changes jobs every 5 years, having about 9 jobs over their lifetime and working for 6 different employers. And for millennials, that number jumps to like 15 jobs. All those job changes, plus provider changes like this one, can quickly add up to a confusing stack of pension pots.
That's where pension consolidation comes in. This means combining multiple pension pots into a single scheme, usually either your current workplace pension or maybe a separate private pension. The benefits are pretty clear. Simpler planning, much easier tracking of your overall wealth, and potentially lower fees across the board if you choose well.
Sounds like a no-brainer.
Well, not always. This isn't a decision to take lightly. Before you consolidate, you must diligently compare the charges and investment options of the different schemes. Be extremely careful because some older pensions may charge significant exit fees, or you could lose valuable benefits like an entitlement to more than 25% tax-free cash or certain guaranteed annuity rates. Those can be really valuable.
Ah, okay, pitfalls to watch out for.
Exactly. If you're unsure, seeking independent financial advice is paramount here. Our sources reveal a startling statistic that underscores the problem of multiple pots. A 2022 Pension Policy Institute study found 26.6 billion in lost pensions in the UK.
26 billion.
Yeah. Billion, yes. That's a massive amount of money just floating out there unclaimed. If you suspect you might have a lost pension, the government's pension tracing service is an excellent free resource to start your search. Definitely worth doing.
That's a huge amount of money just floating out there.
Hmm.
So, that brings us to the next logical question for many people. Is a private pension worth considering beyond your workplace one?
For many, yes, it
Yeah.
absolutely is. A private pension, sometimes called a SIPP, self-invested personal pension, is one you set up yourself, independent of an employer. The key advantages are flexibility with contributions. You decide how much and when to pay in, and typically a much wider range of investment options. They can also sometimes offer lower overall charges than older workplace schemes.
Yeah.
They're often used to maximize any employer matching you might get at work. Make sure you get all the free money first. And many people consolidate their old workplace pensions into their private one if they move jobs or their employer switches providers. This means they often end up with just two main pots to manage: their current workplace pension and their private one. Much simpler.
That makes sense.
Given the vast number of providers and options, consulting an independent financial planner can be really helpful here to navigate the choices and find what's right for you. And while you're looking at your workplace and private pensions, please do not overlook your state pension. It's such a fundamental building block for your retirement. You can easily check your record online at gov.uk, check state pension. It only takes a few minutes, and you'll learn how much you're on track to receive, when you'll start getting it, and crucially, if you have any gaps in your national insurance record.
Okay, and why are those gaps important?
Because you need 35 qualifying years to receive the full new state pension, which in the 2025-26 tax year is worth $230.25 per week, or $11,973.80 per year. This forms a really good financial foundation. If you do have gaps, you might be able to top them up. This could cost only a few £100s in some cases, but could potentially boost your retirement income by thousands over the course of your retirement. It's truly worth checking.
Okay, definitely adding that to the list. Now, this next one is honestly one of the most overlooked but truly critical aspects of pension planning: checking your death benefit nominations.
Wait, so you're saying even if I have a will, my pension isn't covered by it? That's a huge blind spot for many, surely. That's right, it's a massive blind spot.
Yeah.
Yeah, a really common misconception, actually. Most pensions operate under trust law, so they fall outside your estate and are therefore not covered by your will. Instead, each pension provider has its own separate nomination form or process, sometimes called an expression of wish form. This form tells the pension trustees who you would like to benefit from your pension should you pass away. While the trustees technically have the final say, they consider your wishes but aren't strictly bound by them for various legal and tax reasons. They usually follow your nomination unless there's a compelling reason not to.
Okay, so you need one for each pension.
Yes, absolutely. You'll need to complete this for both your Fidelity pension and your new LifeSight pension separately, and any other pensions you have. There's typically no cost to update these, and it should definitely be part of your annual financial checklist, especially after major life events like marriage, divorce, or having children. Imagine the heartache for your loved ones if your wishes aren't clear.
Yeah, really important point. So bringing this all together, what does this all mean for your overall financial plan? This pension provider change seems like an ideal prompt to step back and review your entire financial future, not just the pension itself.
Exactly. This is your chance to ask yourself the big questions. When do you really want to retire? How much will you actually need to live off comfortably in retirement? Is your pension currently on track to provide that? What other savings or assets will you have to help you reach your goals? There are excellent online calculators that can help with this, including some on your LifeSight account, usually. If you find you're not quite on track, don't despair. There are three main levers you can pull to increase your chances. First, save more. Even increasing your contribution slightly, say an extra $25 per month growing at 7%, could add over £20,000 to your pot after 25 years. Little bits add up. Second, improve your investment strategy. Choosing funds that truly match your goals and risk tolerance can significantly improve growth over the long term. Don't just stick with the default unless it's right for you. And third, reduce your pension fees. A 1% difference in annual charges might seem small on paper, but honestly, it can cost you tens of thousands of pounds over a few decades. It really erodes your returns.
Those are powerful levers.
They are. And these can be complex decisions, which is why, as we've mentioned, a financial planner can be of huge benefit. There was a Vanguard study that identified 7 key areas where advisors add value, estimating the total value they add at around 3% per annum for their clients through things like behavioral coaching and optimal asset allocation.
3% a year, that's significant.
It really is. A powerful return on investment in getting proper advice.
That's a powerful thought to leave us with. So to recap everything we've covered today, here's a quick checklist of action points for you listening to get started. First, set up online access to both your old Fidelity and new LifeSight pensions. Get those logins sorted. Second, review your budget and contributions. Can you maybe save a bit more for your future? Third, check your contribution method for tax relief, especially if you're a higher rate taxpayer. Make sure you're claiming everything you're owed. Don't leave money on the table. Fourth, review your investment options for both your old and new pensions, and definitely look into those ESG options if aligning money with values matters to you. Fifth, check and update your death benefit nominations for both providers. Crucial. Sixth, consider consolidating your pension pots to simplify your financial life, but check those fees and benefits first. And finally, take this opportunity to review your entire financial plan. Look at the big picture.
And perhaps to leave you with a final thought, ask yourself this. What stands out to you from today's deep dive that you'll action first to take control of your financial future? Remember, your pension isn't just a number on a statement. It's a powerful tool for building a life you want to live in retirement.